Please start your live.
Good evening, everybody. Thank you for joining us here again on another edition of the monthly market insight. Every month, we attempt to share with you some of our thoughts on what's happening in the economy, other events. For a change this time, of course, there will also be some geopolitics. And we also typically have one of our fund managers joining the session, so they're able to talk about their strategies in detail. Today, my colleague Ankit Agarwal will be with me on this call. He manages, as many of you would be aware, our mid-cap strategy and also our small-cap strategy. So it's going to be a pretty eventful session, I hope. There's a lot that we need to cover, and I'll try to do my best. I think today, as in previous sessions, there's also going to be a poll which is going to be run. So do take part in the poll and engage and give us your replies. It helps us understand not just some of the pressing issues on your mind, but also how you approach investing and what you would like us to sort of cover in these sessions in more detail. So look forward to your participation in that poll. Without any further ado, I'll just now request my colleague Niranjan from the marketing team, and he's going to get the presentation up on the screen, and then we can get rolling. Right. So that's the monthly market insight webinar with me and Ankit Agarwal, our fund manager. So we can just dive into the list of topics that we are going to be covering today. There's a lot of talk about the current drawdown in the market. So I thought it was an appropriate time to update a chart that we had shared with you just 2 months ago, and also talk about how India has done in a global context and what global valuations look like. One question on which we get a lot of sort of debate is around the whole issue of FPI flows. So we'll cover that as well. And then, of course, we'll run through our normal section on the economy and also our normal section on valuation before I hand over to Ankit. So without, let's move ahead to the next slide. Now, this is actually a slide we showed you in January. And at that point, we said that, volatility is nothing unusual in the equity markets. It is not a bug, it is a feature. And we showed you the data going back all the way to 1979. And we said, if you see in any given year, the peak to trough fall in the market on average has been 20%. So if you're an investor and you're coming into this market, your baseline expectation should be that sometime during the year, the market would have a drawdown, and that drawdown could be at the lowest, something like maybe 3 or 4%. In the worst case, it's been as bad as 55%. But on average, it's been about 21%. And when you look at it from that context, what's happened in January, February, March is nothing unusual. From the peak in January to the low trough in March, the market has fallen about 14%. So when we presented this in January, the market was doing quite well. And then, of course, fast forward to today, the peak to trough drawdown is 14%. But the point I would make in a historical context, there is nothing absolutely unusual about this. Volatility is a feature of the equity markets. Moving on to the next slide. This, just gives you the context that when you think about equity markets and the returns that you've been able to earn over a very, very long period of time, almost 40 years, you look at that CAGR of 15%, it's a story of progress interspersed with setbacks and with multiple crises. So always remember those words, why do we fall? So that we can learn to pick ourselves up again. It's something which is true not just of what Alfred Pennyworth said to Batman, but equally very, very true of the markets as well. So nothing unusual about volatility. That is pretty much part and parcel of equity markets. Now, moving on to the next slide, where we'll talk about is the drawdown in India this year unusual? So we've got a list of markets here, the same set of markets for which we normally present the data, and you can see the peak to trough drawdown in those markets. Now, obviously, at the extreme left is Russia, which is at the center of this re-emergence of geopolitics to the center stage because of the military conflict that's happening, unfortunately, in the country of Ukraine. Great human suffering over there today. But from an market point of view, when you look at this, you can see India pretty much sitting somewhere in the middle of the pack, not the worst, not the best. And if you look at the markets on the extreme right-hand side, you'll see that it's Indonesia, Brazil, South Africa. And if you think a little bit deeper, you'll realize that all these three economies are actually quite commodity driven, not just in their economy, but also in their stock market. And to that extent, they have not done as badly as some of the other markets. Nothing unusual about that. Again, if you think about Indian stocks, one of the best performing sectors in the last 2 months has actually been the commodity space. So it should be as no surprise that if in India commodities can be the best performing sector, a country which is dominated both economically as well as its stock market by commodities has done much better than India. But point being, it's not only India that has fallen, markets across the world have fallen in response to the geopolitical conflict and the military conflict in Ukraine. Moving on to the next slide. I just wanted to make one point, and I keep talking about valuations. We talk about valuations in an Indian context. And we always say that markets mean revert, which is to say that markets never are static. Yes, they hopefully trade in the fair value territory for extended periods of time, but there are periods where they become expensive and there are periods where they become cheap. We had global equity markets, much like Indian markets, go into record expensive territory post the pandemic and the monetary and fiscal support that was provided. And then as economies have recovered, earnings have started to come back. But with this fall, valuations have, sort of pulled back. Now, the point I would like to make here is that just as investors, and we keep referring to those charts of the P multiple, the price to book multiple, and we keep repeating that asset allocation is very, very important for any investor, because there will be periods where an asset gets excessively priced. There are periods when an asset is, very, very undervalued, and those are the times that investors should try and rebalance their portfolios. There's nothing unusual about the fact that so many equity markets across the world have sold off because their starting point in terms of valuations over the last 6 months was very, very expensive, and therefore their ability to handle any adverse news flow or developments is far more limited. So, an expensive market selling off should not come as a surprise. Neither should a cheap market then recovering quite sharply come as a surprise, which is exactly what happened even in the global markets in March of 20. You can see the markets got extremely cheap and then they rallied from there. So, valuations do cause markets to either pause or correct, or they cause markets to over time then go up because the markets are not really looking at upside risk at that point. Moving on from that, a lot of discussion about FPI flow being negative. There is no doubt. It's been a fairly dramatic 3 months. We are not through the full year. So in a way, this chart is, not telling the full picture. We'll see what this number for FPI flows look like at the end of the year in December 22. But, I just wanted to stand back and say, when you look at 20 plus years of data, then yes, there have been a few years where foreigners have withdrawn money. This year, to date, looks like one of them. But in general, India has actually been a net beneficiary of foreign flows. So, that's the context that we need to keep in mind when we think about FPI flows. And in fact, when I started my career, in the markets going back to the early 90s, foreigners started coming into Indian equities only in 1993. So you could argue that, the foreign stake in Indian equities was zero in 1993. It's gone up all the way to about 22-23% today, which tells you that foreigners have been actually a constant net buying influence on the domestic market. Now, the question that most people keep asking me is, why are foreigners selling? When will they stop selling? So on and so forth. And I thought it was a good time to do some analysis of that. And, that's what we'll attempt to do on the next slide, where I'm saying what is driving FPI flows. But actually, I'm not going to answer that question. My question to you is, does it really matter, right? Because if you see a market which gets expensive, the market eventually finds a reason to mean revert. It finds a reason to come back to more sort of fair value kind of valuations. Equally, there are times where the markets will find a reason to go to cheap valuation. There are some things which are in our control, and there are some things which are not in your control. And I think as investors, we will all be far more effective if we focus on what is in our control and avoid focusing on what is not in our control. So what is not in your control? The weather, the traffic, your neighbors, your colleagues, the minds of other people. The markets are not in your control, volatility is not in your control, and neither is FPI buying or selling in your control. They have their own process, they have their own metrics they are looking at. And remember, they are not limited to buying only India. FPIs are investing across the world, and they have their menu is much wider than many of us who are predominantly India-dominated investors. And therefore, if they find value for money in some market more attractive compared to India, that is no different from an Indian investor finding a particular stock more attractive than the other because of valuation. So my only suggestion to you is that you need to have a model of how do you approach investing. And to our mind, the model which works best for investing is to think about asset allocation as an investor. It is to think about valuation as an investor. We certainly think about valuation in the way that we, execute our portfolios. The choice of valuation metrics may be different. Somebody could prefer price to book, somebody could prefer price to earnings, somebody could prefer price to growth. Our growth and quality strategy prefers to look at free cash flow and growth in free cash flow. So your choice of metrics could be different, but what is important is to focus as an investor, whether you're a mutual fund, whether you're an individual investor, in the factors which are in your control, your emotions, your expenses, because remember, eventually the amount you invest is equal to income minus expenses. So the less you spend, the more your ability to invest. What is in your control? Your financial goals. What is in your control? Asset allocation. And how should you think about asset allocation? In line with your financial goals, but there needs to be a value for money orientation. So when you find an asset class attractive, you put more money in it. When you find an asset class unattractive, you take money out of it. Just as you would do that, remember, there are foreign institutional investors of different kinds sitting all over the world. They have options to go anywhere in the world, and they do choose at times to either do asset allocation calls because they need to rebalance their portfolios, or they might be taking country choices. The other thing which is in your control is SIP or STP. So my simple point is, we are wasting too much time trying to discuss FPI flows. I don't think it really matters. We don't think about who's going to buy and who's going to sell in the stock market on a daily basis. By the way, if nobody buys, if everybody's only buying and there's nobody to sell, then trading wouldn't happen on the exchanges. So, it's very necessary. And remember, for every transaction, there's always a buyer and a seller. Trying to interpret who's the seller or when he will stop, in my opinion, is sort of a pointless task. It should not be part of investment process. What should be part of investment process is asset allocation and that value for money orientation in trying to allocate your assets. And of course, the STP takes care of not having to look at such issues at all. So that's it for the FPI front. Very quickly, we just move on now to the next set of slides. Yeah, we can just, right. Nothing much over here. There's no change in the forecast earnings numbers, more or less static. So, the next slide shows you how the earnings forecasts are behaving in terms of have there been any significant upgrades or downgrades. You can see the yellow line more or less flat. That's the line for 22. The lighter blue line is the line for 23, some marginal upgrades. 24, I would say, don't look at it right now. It's not very relevant. The next slide shows you what's happened to both the trailing PE and the forward PE multiple. And this is very, very interesting. After a long time, and we kept saying markets are expensive, markets are expensive. Now you can see that on a trailing PE, the market has dropped back into the fair value territory, which is the area between the red line and the green line. And on a forward basis, again, it has just about managed to drop back into the fair value territory. So yes, the drawdowns will happen in the market, but when the drawdowns happen and pull down valuations into fair value, it creates an opportunity for investors. And certainly in the large caps, we can see that they have, as a result of this fall, entered the fair value zone again. On the next slide, we've got the price to book. This indicator is still not yet back into the fair value zone. And I think the reason for that is on the right side chart. You can see the return on equity. It's now climbed to a level we have not seen in 7 years. So yes, the price to book is slightly higher than historical, but that's partly perhaps explained by the fact that the ROEs are also the best that we've seen in corporate India for many, many years. So again, there are multiple ways of slicing and dicing valuations. Everybody has a preferred indicator, but I think the good news is at least some of the indicators are now back in the fair value zone for large cap stocks. The next slide shows you the charts for the mid cap and the small cap. Both of these are yet to really sort of correct back into the fair value zone. We are showing here only the price to book, but even if you look at the P multiple, with the small cap still in the expensive zone, the mid cap slightly closer to dipping back into fair value, but not yet there. The next slide shows you the valuation related to the 10-year bond. So when the blue line, the dark blue line, which is moving around, when that is at the yellow line, then you're sort of neutral between equities and bonds. When that volatile line is below the yellow line, then it is not so attractive for equities. But as you can see, because of the fall, we are at least coming back towards sort of the neutral value. So again, this indicator not yet indicating a positive or a fair value zone, but coming quite close to it. The next slide shows you the large cap versus mid cap valuation. Not much to say over here. You've already seen the individual charts. So yes, the mid cap still at a premium to the Nifty 50. So yes, large caps back in fair value, but the mid caps and small caps yet to do that. Moving on from this, we've covered a lot of the slides, standard valuation slides. I know many of you are now thinking about, the events of the last few weeks. Oil prices up quite significantly. So what does it mean? So we just put some statistics here so that you can sort of understand the sensitivity by yourself. Just remember the average crude prices were in the region of about $75–80 a barrel in the quarter ended October-December 21. Now, every 10% increase in the global oil prices impacts CPI inflation by about 23 basis points. So if you think that the price of oil has gone up on average by about $30–40, then effectively that would mean that it could push CPI higher by about 75 to 100 basis points. As far as the current account deficit is concerned, if you take the oil price at $120 a barrel, and if you presume that this stays the price for the entire year, which may or may not happen because the conflict could end, new sources of supply could emerge, then approximately India's fuel bill could go up by about $50 billion because our net imports are 1.25 billion barrels of oil in the previous 12 months. You multiply that by $40 and you get a number of 50 billion. So that's the potential hit from higher oil prices if they stay the same over the course of the entire year. The government could cut duties. Last year, the specific duties on diesel and petrol, the government raised almost $43 billion. Obviously, they can't cut the entire thing because that would completely dent the fiscal. But there is some scope for readjustments, which could be done in duties, and there is some margin. But yes, that would dampen the price increase and raise the fiscal deficit. So it's a very difficult decision to make about which way to go. All these sensitivity estimates are based on a full year basis. We're still waiting for the price of petrol, diesel to go up because it has not been done for 3 months, most probably because of the state polls. So it should happen in the next few days or weeks. And then as of now, perhaps the 14-day average of crude is closer to 110, 111. So, you could see some sort of a price hike, also accompanied by a cut in duties to reduce the immediate impact. But the point I want to make is that we are dealing with probabilities, not with certainties. Why do I say that? Because we don't know whether these elevated prices will stay the same for another day, another week, another month, another year, or even longer. So we are dealing with probabilities rather than certainties at this point of time. Finally, on the last slide, not much to add. I think I've talked about most of these points earlier, so I'll just leave it there for you to sort of digest. To my mind, the 2 points to make: the length of conflict in Ukraine and the subsequent sanctions. This is what will determine the impact on India and the global economy. If this is just a 2 to 3 week affair, the world can sort of absorb it without too much damage. But if it lasts over a longer period, then there will be pain that every economy will have to absorb. But thankfully, India's starting conditions are quite favorable in terms of macroeconomics, FX reserves, current account deficit, capital flows, corporate India balance sheets, deleverage, bank balance sheets in good shape, scope for credit cycle to be supported. The biggest change compared to, I would say, the sort of webinars that I've been doing for many months now, maybe almost 6 to 8 months, is that valuations have once again dipped into the fair value zone for large caps. So, those are about the key thoughts that I wanted to share with you. Volatility is normal. The drawdown we've seen recently is not abnormal. All world markets have corrected. You need to focus on what is within your control, which is asset allocation with a value for money orientation. What you are seeing in global markets, FPI withdrawals, all markets have fallen. So maybe there is rebalancing happening at a global scale. Again, nothing unusual. None of this volatility is unusual. But it's creating an opportunity for investors because after a very long time, valuations, at least in large caps, have come back to the fair value zone. So I'm going to pause over there. And as I mentioned at the beginning, we're now going to move on to the next section of today's webinar, where my colleague Ankit Agarwal will be talking about the mid-cap and the small-cap strategy. Over to you, Ankit.
Yeah, thanks, Vetri. So we will sort of recap the investment strategies for the UTI mid-cap and the small-cap fund. As Vetri rightly pointed out, that we do not have control on external factors. What we have control over is what is the stocks that we are selecting, what is our investment strategy, and I think it's a good time to relook at how we go about selecting stocks in the mid and small cap space. Next slide. Yeah, so basically, the core of the portfolio, if I were to sort of talk about the core, which is almost, or 70% of the portfolio, what we are trying to buy are, consistent growth companies, which have a sustainable business model and have a long runway of growth. And these companies are typically run by seasoned managements. And therefore, they carry attributes like profitable volume growth. They have either cost leverage, they are innovative, and they do end up generating higher returns on invested capital. So you can look at some of these companies as companies which can possibly compound your earnings over a period of time. So the core of the portfolio lies in such high quality businesses. Then we also invest around 30% of the portfolio in companies which are, maybe good businesses, but might be going through a temporary phase of downturn. And if you buy some of these opportunities early, and when the macro environment or the business environment for some of these companies turns around, you not only benefit from valuations going up, going to mean reversion, but also get benefit of significant operating leverage. So the scope for creating significantly high return is also there. We also invest a part of our portfolio in what we call transformational change, where basically it is possible that a business might be undergoing a transformational change owing to maybe something changing in the sector, or maybe there is a change within the company itself, which could lead to a structural re-rating of the stock. So that is basically how we sort of our investment approach in both the funds, where the core remains more quality sort of focus, and then we also sort of complement that with certain amount of turnaround and transformational opportunities. So the focus is basically wealth creation, with both giving it a good balance of growth opportunities along with some value opportunities. Next slide. So the mid cap fund specifically, if you look at, we do buy a large part of our portfolio in what we call large cap isotopes. And, a lot of times I get this question, that mid caps are, riskier investment, large caps are more stable investments. And, the thing which I do tell a lot of our investors is that do not look at riskiness from a market cap perspective, right? The reason why people like large caps is because they typically, most of the large caps would be leaders in the segment that they operate in, run by good, quality professional management. They'll have good access to capital, and they will be able to provide consistent growth to their investors. But our sense is that you can find similar, or similar characteristics, and therefore, we borrowed from chemistry over here. You'll find similar characteristics in mid-cap companies, which could be the leaders in the space they operate in. It's just that the sector in which they operate in could be much smaller and may not be represented well in the large cap space. And that gives them similar chances of being market leader, their ability to gain market share in a tough environment, ability to maintain margins, have more pricing power, ability to access capital. And, there also will see a long track record of consistent growth over the years. It's just that, because they are in that segment, which is much smaller today, that they would be in the, their market caps would be low. So a lot of the companies that we have listed here are leaders in that space they operate in. And that's the core focus, of the mid-cap strategy. Next. And yes, so I mean, this is, a good outcome. If you see the performance of the mid-cap funds, typically, or the mid-cap index, it has on an average, outperformed on the long-term basis also, some of the peers like the Nifty 100, and even in some cases, the small cap 250. And although the risk associated with it would be higher, but you do get compensated for that higher risk that you take in the mid-cap space. So I think from a risk-adjusted basis also, it's a decent strategy to look at. And if you are able to, your stock selection is right, and you're able to avoid some of the wealth destroyers, you should be able to provide over and above the index return to your investors. This one basically looks at the SIP performance of the funds, of the mid-cap fund across the years. And, as you can see, in the last 1 and 3 year horizon, we are, it's outperforming the mid-cap 150. And, the question that I often get, about, timing the investment, whether this is the right time to invest, or, whether we should wait for a market correction, or, are we investing at very high NAVs? My simple submission to all those queries have been that, you can't really time the market. You can't, neither can you predict the tops, neither can you predict the bottoms. The only sustainable strategy is to do a systematic sort of investment plan where you keep putting money into the market at different points in time. Therefore, you get benefits of both upside and downside And it's very important in times of volatility, or specifically when you see big drawdowns in the market, to make use of those drawdowns to continue with your SIPs, because only if you do that will you get benefit of the SIP over the long term. So I think the case over here is, maybe your investment horizon might go up, but you will still continue to make good returns. So we launched the UTI Small Cap Fund, last more than a year back, and the reason we launched this also was because the large cap, if you look at some of the heavyweight sectors in the large cap space, a lot of them will be concentrated in very few key sectors like financial services, oil and gas, IT. But if you want to get exposure to a wider array of sectors, which could be the growth sectors of tomorrow. Today we talk about, chemicals as an opportunity of China plus one. We talk about a huge amount of under penetration when it comes to consumer durable space. Building materials is an emerging opportunity in India. In fact, a lot of PLI related companies where, who stand to benefit are present in the mid and small size space. So actually, from in industry or the sector diversification perspective itself, it makes a lot of sense to be in the small cap opportunities, because that gives you a balance from a large cap heavy sector, namely in oil and gas, financial services, and IT. So I think not only you find a lot of emerging opportunities in the small cap space, but you do also find diversification away from large cap heavy sectors. Next. But I think and a lot of the opportunities in the small cap space are under research and under owned, which means that you do not have a lot of sell side coverage, and therefore it becomes very important that you have a very strong in-house framework and also coverage of some of these stocks, so that you are able to choose the right quality small caps, which have good quality management, have a strong track record of performance, are able to deliver strong execution and have a long runway of growth, so that you can not only buy good quality companies, but also avoid some of the wealth destroyers. And I think in the small cap space, it becomes very important that you pick the right stocks, because mortalities with respect in the small cap space could be fairly high. So our focus is consistently on having a very strong investment process. We have a fairly large experienced research team who does the whole hard work of kicking the tires, looking for, doing the channel checks, doing a lot of primary work, talking to distributors, talking to experts, and making detailed financial models to understand whether it's a company, worth looking at and, covering it for long term, and whether they will be able to create wealth for their clients. So I think a very strong investment process and research is very important in this small cap space to find winners and avoid some of the losers in this in the small cap universe. And very clearly, I think we do look at from a valuation perspective. While we have seen that small caps and mid caps are still on the higher side with respect to their long-term averages. But the only point there with respect to small caps specifically is that we are still below the December 17. So if I break down the 500 Nifty 500 index composition, we are still in line or slightly below the highs that we saw in December 17. So I think we have done a bit of catch up. Yes, when we launched the fund, there was a clear scope of which we launched in, if you see from December 20 to 21. But I think the play here is, choosing the right companies which can continue to compound your earnings over a period of time. Maybe a pure index-based strategy may not completely work. So I think with a good stock-specific, bottom-up investment opportunities, you may, and if you have sort of a longer-term horizon, you may continue to see decent returns from the small cap space. Yeah. Yeah, that's all from my side. Yeah, pass it on to Niranjan for further part of the presentation. Thank you.
Right. Yeah. Thanks, Ankit, for the rundown on mid cap and small cap fund. And while Vetri mentioned that valuations in large cap has approached the fair valuation zone, when you are in fact rightly put that when it comes to mid and small cap, picking the right stock is always important, and holding to them in the long term will certainly help. Yeah. So just a quick reminder to the participants, while we have already received a few questions in hand, which we will take it up here, 2-3 questions, and we will request you to continue to post your questions using the chat box. We will take as many questions as possible. The first question here is, it is for you, Ankit. Mid and small cap indices continue to trade in a rich valuation despite of a sharp correction over the last few weeks. So what is the risk framework adopted in your fund to mitigate portfolio risk? So apart from that, you mentioned that picking the quality stocks. So what are the things you think is actually helping the portfolio?
Right. No, I think it's a very important point that you have to have a fairly strong risk framework when it comes to investing in mid cap and specifically small cap universe, because we do understand that the risk of drawdowns is much higher in small caps. So there are a number of things we have tried to do in the mid and small cap space. Number one, we manage our portfolio with a fairly diversified holding structure, which means that we do not take significant risk from a stock specific perspective, and the risk of mortality with respect to some idiosyncratic thing happening in one specific stock is significantly reduced. So that diversification actually helps us to mitigate any stock specific risks which you might incur. Secondly, also from a liquidity perspective, while while the small cap space may give you significantly high returns, the issue is that the impact cost of getting in and getting out of the small cap space is fairly high, and therefore in order to be able to exit a stock in case there is some negative development which might happen, you may have to and so that you do not incur significant impact cost, the whole diversified portfolio also enables us to sort of reduce that impact cost significantly. Thirdly and lastly, I would say that our focus on having the core of the portfolio in high quality franchises, which are run by good management, which have strong track record of performance, high return on capital, I think that has really helped us to hold on to the portfolio in tough times. And that's our sort of focus, that you should construct a portfolio which does well during periods of drawdowns, and automatically you will see that some of that performance come back when the markets look up. So I think combination of these three helps us to mitigate some of the portfolio risks in this space.
Sure. Thanks a lot. There is one question on the corporate earnings. Vetri can pick this up. So, Vetri, what is the risk to the corporate earnings estimate for the financial year FY23 due to the heightened uncertainties?
Sure. So I think at this point, we have not yet seen any adjustments being made to the FY23 forecast. Without doubt, if this current supply side disruption, which as you are aware has caused crude oil prices to go up, natural gas prices have gone up, steel, aluminium, fertilizer, coal, edible oils, wheat, many of these have seen sharp price rises. The reason for this is that essentially Russia and Ukraine are a very significant part of the global supply chain for all these products and commodities that I mentioned. Now, the impact of these higher prices will not just be on inflation, but in a sense, it could also transmit quite a bit into corporate earnings, because companies may not be able to pass on earnings at the same speed to end consumers. They may have to absorb some of it. So at this point, it's very early days to say what can be the impact on FY23, except to say that if the prices continue to sustain at the current level that they've reached, so if you were to use one number, as I said, $120 a barrel of crude oil, that's the price compared to $80 a barrel, about 3 to 4 months ago. That kind of a level would certainly bring pressure to bear on all companies which have petroleum-related products in their supply chains. And there will be certainly risk to earnings, because the companies may not be able to pass on the entire burden to customers. And of course, in some cases, they will certainly attempt, or they may be able to pass on the entire price increase. But then you run the risk of customers sort of pulling back because of the sharp increase in prices. So I would say, is there risk to corporate earnings in 23? Certainly there is, but it's very hard at this point to be certain about exactly how much the quantum of risk is, because we really don't know anything about how long this conflict itself lasts. So if the question is there risk? The answer is yes. How much risk? It could be quite significant, but that's a function of how events play out and the longer the conflict persists. If it lasts only for 1, 2, 3 months, then it will not be significant. But yes, if it lasts a full year, then the impact on corporate earnings will be quite significant. So I'll just leave it at that to say there is a risk to corporate earnings in FY23.
Yeah, sure. Thanks. In fact, that was the question coming from a couple of online participants as well. The next question, this is on mid and small cap space. So Ankit, you can take this. So in the mid and small cap space, which segments are overheated and which segment do you find attractive from a medium term perspective?
Yes, I think clearly, some of the sectors on the commodity side, if I look at their valuations from their long-term trend perspective, are trading at their peak valuations, and therefore I would say that there seem to be a little bit more overheated at this point in time. I think some of the sectors which obviously take raw materials from some of the metals and which have some of the key raw materials as metals, I think there we have seen a significant impact on margins, and which might even continue in the shorter term. But I think some of those segments are providing good, attractive opportunities from a medium to long-term perspective. So whether it's on the auto side, which anyways where valuation had corrected, and we have seen a long sort of a bear market over there, I think provides good opportunities. I think some segments, the durable side also, which have gotten impacted because of the rise in commodity prices, could see some benefit going ahead if some of these commodity prices cool off. So I think I would be sort of a little bit more wary on pure commodity-based businesses today, which have been benefiting in recent times, versus the ones where you are which are the key raw materials and have gotten impacted in the near term.
Yeah, sure. Thanks, Ankit. So now we will take a few online questions. The first question is actually coming from Ms. Ruchi Goyal. In fact, this is a question similar to what actually Vetri already addressed in the deliberation. But here, in addition to the impact of the oil price going up due to the unrest that we have seen coming from Russia and Ukraine unrest, so will this continue to have an impact on the retail consumption, and also further leading to having an impact on the fiscal deficit? And lastly, to what extent would this also derail the infrastructure plans, and also would it lead to kind of like derail in the whatever the government's fiscal runway that they have kept? So if you can throw some light on this bit.
Yeah, so again, just to go back to the comments that I made earlier, look, if this conflict persists, right, because this is a sort of conflict that we have not seen for many years. You cannot compare this to US, Afghanistan, or Iraq, or any of those events. So if this conflict persists and if the supply chain stays disrupted and prices stay elevated, then I think there will be significant consequences of this for everybody. All global economies, the global economy will face a challenge, and the Indian economy will also face a challenge, because in economic terms, even though it is exogenous, this is effectively a terms of trade shock, where suddenly the things that you import end up becoming so much more expensive compared to the things that you are capable of exporting. So the cost of your imports goes up, but not necessarily that you have a corresponding benefit on the export side. So I think that would be a significant issue for India and for all countries. It will be a fiscal issue. It will be a issue in terms of inflation. It will affect consumer spending patterns, because a lot of the products where prices are spiking higher are in the nature of essentials, where beyond a point it's very difficult for consumers to cut back their spend. So I think the negative ramifications of that can be quite significant if those prices persist. If the crisis ends far sooner, there is a compromise of sorts, then it wouldn't really have a significant impact. I think in all of this, I would again just reiterate one thing, which is that when you are investing in equity, as we discussed several times, valuations matter, and also the progress that equity markets make over a long period of time includes periods where things are challenging. We could not have believed when we went to a lockdown in March 2020 that the impact of a lockdown could end up becoming a stock market which is significantly higher over the next 2 years. So there are compensating factors. There are reasons why markets behave the way they behave. There are valuations which are attractive and valuations which are unattractive. I would just say that when you are challenged with so many variables which are very hard to decipher as to how they will play out, go back to looking at the few variables that you will be able to understand and manage. As I said, one is asset allocation, second is valuations, and at attractive valuations, the case for increasing allocation to equity certainly becomes attractive. It's true of the large cap space, not of the rest of the market. But as I said, every single economic parameter will get impacted if this conflict and elevated prices continue. I should also point out that if the prices stay elevated, at some point you will see both a demand softening, because in response to the higher prices, demand will soften, and eventually at some point there will also be a supply response, right? Because somebody will say, hey, I have spare capacity where I can produce crude oil or fertilizer or something like that. Some commodities there may be more spare, some there may be less, but there will be a supply side response. We do know that there are countries in the Middle East which have spare capacity. They could start to bring some of that capacity on stream. Iran has been locked out of the global oil market. They have some sales, some perhaps unofficial, but certainly locked out of the global market because of sanctions. Nuclear deal there could help bring back some of their supply on the market. US shale gas and Canada. We know that the lead time required to ramp up production is quite small. It's months, it's not years. So there will be a supply side response, but the time that it takes either for resolution or for the supply side response, that intervening period will be a challenging.
Thanks a lot, Vetri, for that detailed answer. The next question is coming from one of the investors from Telangana, Mr. Narayana Rao. His question is on active versus passive funds. So while the one-year performance of active funds continues to be strong, the recent drag in markets has led to underperformance of funds primarily in large cap category. So what is driving the underperformance, and would this trend likely to continue for long? So
So again, my only answer to this, and I always keep pointing this out, is there is space in everybody's portfolio for passive and for active. The basic promise that passive gives you is that we will get you the index return minus the tracking error, and because expenses are low, if you manage the fund well, your tracking error can be quite low. So at a very effective and efficient cost, you get a return which is pretty close to the index return. As far as active funds are concerned, they can create alpha, which a passive fund can't create. But the challenge is which fund will create the alpha and which part of the cycle will it create alpha. So to my mind, there is room in every investor's portfolio for both these products. Just like we don't say, I only want debt in my portfolio, I only want equity in my portfolio. I only want large cap in my portfolio, now I want only small cap in your portfolio. See, life is about balance, and your investment portfolio also has to be about balance. How much allocation do you have to large, to mid, to small? Then you want to have some passive, you have some active, you should have both. How much? Each person may reach a different conclusion as to what is right for them. How much debt, how much equity? Again, each person will have a different thing of what is the right number for them. So I believe there is space for both, and trying to sort of continuously figure out which is the more appropriate one for the next 3 months, 6 months, 1 year. In theory, it's fine, but in practice, virtually impossible to implement such a strategy. So I would only say, sir, that please use both in your portfolio, and every client's requirements may be different in terms of which is the product and what its weight should be in their allocation.
Yeah, sure, Vetri. So there are a couple of questions on sectors, so we will take them up. So there is one question on IT. Maybe Ankit, you can take this question. So although IT sector managed to successfully sail through the COVID-19 times, so with recent correction, are there any specific headwinds affecting the revenue and earnings margin for the businesses in IT sector? And how do you see this sector in the next few quarters?
I think at least from a near to medium term perspectives, our conversation with companies, consultants, etc., has been on the positive side. I think there is a significant digitization shift towards cloud, which is happening globally, which is driving growth for most of the IT companies. Second, I think there is also supply crunch from a labor market perspective. Not only in India, but also globally. And possibly that is also driving a good amount of outsourcing as far as the IT budgets are concerned. So I think a combination of these, it does look like the IT upcycle might last a bit longer. And therefore, we do continue to remain sort of overweight, at least in some of our strategies on the IT space.
Sure. There is another question. So on BFSI sector, so you can take this up again. So the credit growth seems to be improving recently after remaining benign at 6% for quite a long period. So is this trend likely to sustain, and what are the other pockets looking favorable for banking and financial service sector? Revival.
Right. I think, a couple of points which I would like to make here. One is, if you go back 2-3 years back, bank balance sheets were getting repaired. A lot of them went through a significant NPA cycle, but over the last few years, most of them have, provisioned, capital infusion has happened, capital adequacy has improved. And as a result, the ability of banks to lend is in a much better position today than it was probably 3-4 years back. Secondly, actually, if you look at corporate leverage, it is probably down to a 10 to 12 year low today. And the sense is that probably once the economy normalizes, I think there is a case for re-leveraging happening, at least to a certain extent. So the base drivers for for the credit growth to improve are there. Also, from a valuation perspective, a lot of opportunities, especially on the mid-size space, are available at fairly attractive valuation. So I think that does make a case for increasing allocations towards financial services space.
Yeah, thanks, Ankit. Yeah, so maybe we can take another 2-3 questions. Yeah, so there is one question, Vetri, to you. This is on value versus growth, especially the value stocks have done well in the last 2 years period. So with value doing so, with the relatively good performance in the last 2 years, and growth seems to be underperforming over the last couple of months, particularly. So what is leading to the underperformance of growth stocks, and would there be any reversal in its trend sooner?
Sure. So 2 points to keep in mind. One is, I think, and Ajay, our fund manager and head of equity, has talked about this, that growth stocks essentially are stocks which derive their value from the huge growth opportunity that lies ahead of them, which means you're looking quite a bit into the future in terms of realization of value from that stock. The minute you do that, for such stocks, they tend to be slightly more sensitive to any potential increase in rates. And as you know, over the last 4 months, from November, there's been a big change in the delta expectation of, the rate normalization cycle. So I think that is something that you would certainly expect to have some impact on growth stock valuation. I think what we've also seen simultaneously has been this extreme move, I would say, in favor of some of the sectors which typically are more sort of in the value basket, which tend to be the metals, the commodities, the energy space. Though I would still say that, many of these companies were already at record levels of profitability. Yes, there has been a commodity price spike. But again, if you think of the value of every company, just as I described those growth companies, as the value of cash flows accruing to the company over its long-term period, right? Maybe you don't want to look 40 years as you might for some consumer business, you look at it at a shorter period. But even for these commodity companies, you are looking at the value accruing out of cash flow over the next 10, 20, 30 years. Now, unless you believe that the current commodity price and profitability will stay intact for that same period, then you are dealing with something else, because these stocks, when you look at them on some valuation metrics, cheap on P, but not so cheap anymore on some other metrics. So I think it's a little bit more even Steven at this point of time. There has been a significant run-up in some of the value sectors because they are dominated by commodity and energy because of the supply side disruption. But the question to ask yourself is, do you see this as a disruption which will affect the cash flow over the next 20, 30, 40 years of the lifetime of the company? Or is it something which impacts only the next 1 month, 3 months, 6 months, 1 year? If the answer is the latter, then the impact on the actual change in the value of the business is far more limited. So I think we need to be careful when looking at the growth versus value equation. I will finally just say one thing, typically value does better when the market is very cheap in terms of valuation. Now, the market is still sort of fair value, just coming out of an expensive zone. Interest rates at some point looking to go up. And therefore, I think, there's no clear sign at this point to say that growth is better or value is better. You cannot come to the market every day and expect that, is the equation going to say today is better or tomorrow is better. There are few times when you get an opportunity to choose a strategy over another. There are few times when you get an opportunity to choose an asset class over the other, and those come only once in a while. They may not even come in every given year. But I think this is one of those times where there is no signal from the data that you should choose one over the other.
Sure, Vetri. Thank you. Ankit, there is another question to you. This time it is on auto. So volume growth in auto sector continues to be below their peak in 2018. And it is down by 20 to 30% in terms of its volume. So, what are the key drivers of growth for for this sector's revival, and is this a potential sector for investors to go overweight?
Right. So, I think the point that we have made that I was making is that yes, the auto cycle has remained quite muted for the last 4 years almost, and initially it was because of the price hikes that were taken because of the changes in regulatory norms, emission norms, and now last 2 years have been bit on COVID and some amount of rural slowdown that we're seeing in pockets in more recent times. But the sense is that obviously you're going through a relatively muted auto cycle for now quite some time. And if your expectation is that there will be some amount of normalization happening in the economy, maybe probably the COVID risks are behind. I think just from a perspective of it coming back to normal, makes a case that the auto volume should see some amount of revival. Whether it'll happen in the near term, maybe that's a difficult one to really point out. But clearly, from a valuation perspective, you are getting a lot of comfort on some of the names which have seen drawdowns because of this continuous negative flow from first, initially it was because of the emission norms, then it went from commodity prices, semiconductor issues, and that got a little bit prolonged in the current, set of events. But, if you're looking at it from a more, 3 to 5 year perspective, prices are good today. When will the revival in volumes happen? Maybe we'll have to sort of watch out for it. But clearly, even just coming back to normal levels, I think makes a case to have a reasonably good exposure on the auto space.
Thanks, Ankit. One last question to you, Vetri. So in the interest, we already crossed the scheduled time. So the question is coming from Shweta Arora. So in the current times, most of the investors are still uncertain, having a lot of uncertainty on the market. However, the valuation is certainly giving opportunity for asset allocation. So at this stage, would you recommend taking incremental allocation, or also making significant changes to the one's asset allocation? Also, would you recommend a staggered approach for taking incremental allocation? If you can throw some light there.
Sure. So, I would say in terms of a strategy, of course, it's difficult for me to say because each investor's requirement might be different. But certainly, I would say 2-3 things. After a long time, the large cap part of the market has come back in fair value. So, there is an opportunity to invest. Yes, as I said, it's more about probabilities right now than certainties. Also, it's just come into fair value. It's not really gone into cheap. So, if you think about March 20, markets were cheap. You think about middle of 2013, markets were cheap. You think about 2019 or so, markets were in fair value, not necessarily cheap. So therefore, today's opportunity is more of fair value. It's more about probabilities. So I would really say use a staggered approach to sort of increase your allocation to the market, because you are dealing with some level of uncertainty. There is no doubt about that. So that would be the sort of preferred route to increase exposure. And as I said, large cap space, mid and small cap, I think there's still perhaps, those valuations at least are not yet signaling attractiveness.
Yeah, that's from the Q&A side. And we would like to thank participants today for joining us in here. And what we actually done is we would also want to thank a few of the participants.
Thank you very much, Niranjan. And yes, I hope everybody checks in to see who the lucky 3 are. But from our side, thank you very much for joining us here today in this conversation with Ankit and me. I hope we've been able to throw some light on some of the pressing questions on your mind or on your clients and investors' minds. We look forward to connecting with you on a regular basis, and we should be having this session again next month as usual. Till then, do take care, everybody, and stay safe. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.